Good morning. They're starting to jump in. Oops. Good morning, everybody.
Good morning.
Good to see you, Jessica.
Nice to see you too.
So we're going to wait a few minutes and start letting people come in, and then we'll get moving.
All right.
Okay, I'll go ahead and get started. So welcome to week 5. We're very excited that today, Kathy, as you can see on your screen, it's green. And today you guys are talking about money. Everybody likes money. So with that being said, this is being recorded, and please, it makes it more fun when you interact with Kathy, and we will be able to share the recording with you after the session is over. And by all means, thank you to everybody that's participating in the program. Next week is our last week, and we will have a guest speaker. So with that being said, I'm going to go ahead and turn it over to you, Kathy, and turn my camera off, but I'm here for the chat if anybody needs me. Thank you.
Thanks, Nicole. Appreciate it. Good morning, entrepreneurs. Hope you're all doing well and ready for the snow that's going to invade us tonight, right? But certainly it's not going to be around long. I guess Mother Nature just wants to remind us who's in control. So yeah, this is week 5 already. I can't believe how quickly it's going. So hopefully you have all been able to garner the information and put it to good use. Some of you have shared a business plan draft with me, and I am getting to those, and be assured that I will get back with you with comments, and I do appreciate that. So the rest of you, again, I will remind you, please share them with me at any time, and we'll work together to refine it and make it the best plan possible for your business. So as Nicole said, we're going to talk about money today, and money is good. That's what we're all doing this for, right? So the difference between a hobby and a business is what? Anybody have an idea? What's the difference between a hobby and a business? Well, it is the fact that we make a profit, okay? We can do things for fun, and that's a hobby. When we do things to make a profit, we then turn it into a business. And as you will recall, very back in the early sessions, we talked about your business. You have to be passionate about your business. And oftentimes that does start as a hobby or a sideline, and you are so passionate about it that you want to take it to the next level and turn it into a business. That's probably the most frequent cause that we see for people going into business through our office. And that's wonderful. But today we're going to touch on how you can be prepared and what you can do so you position yourself so that you can make money. And so we talked about last week, what is the break-even point and how to arrive at your break-even analysis. So how many do you need to sell before you start making a profit? The example we used is that you're selling a product or service for $10 per unit. So that could be $10 an hour, or it could be $10 for your widget on the shelf. And the cost of goods sold was the cost of the material and the labor that goes into that. And so our profit margin in the example was $4.50 per unit. We established our fixed costs that are $1,350 per month. And so to figure our break-even point, again, to reiterate, we take our costs of $1,350 per month and we divide it by our profit margin per unit of $4.50. That means we need to sell 300 units per month in order to break even. Remember, the break-even point is simply selling enough to cover your bills. There's no profit built into that. So when you sell the unit number 301 in that month, then you're going to start making a profit. So for the break even in dollars of sales, we take 300 units times the $10. So we know we have to do $3,000 in sales that month in order to break even. Okay. So again, in review, it took 300 units just to break even. And so let's say that we want to make a profit of $900 a month. We divide the 900 by $4.50. So we need 200 units more sales to profit our 900. So the question then becomes the 300 it took to break even plus the 200 for our profit, desirable profit. We need to ask if we can actually sell 500 units per month to reach our goal. Okay. And so today we're going to put that to numbers actually. And we're going to be budgeting. Budgeting is just projecting or forecasting. Most of us are accustomed to budgets in our day-to-day living, in our household incomes. And for a business, it's not much different. We look at how much money will be spent, what are our expenses, how much money will be received, what is our income. And in the business, we're going to call that a cash flow projections. So in our personal lives, we refer to it generally as budgeting. And in business, it's a cash flow projection. Again, the financing part, and if you looked at your business plan template, there's even a note that this is often the scariest part for an entrepreneur. It can become very overwhelming, okay? So once again, we've tried to simplify it for you and make it as easy as possible by providing you with the tool where it's kind of a plug and play. So it's nothing more than an elaborate Excel spreadsheet, but we've put all of the formulas in for you. So when you plug your numbers in, it does those calculations. And so we can look at the bottom line in a much easier and simplified way, and then actually see where we're at for a month. Okay. That too is on the SBDC website, and there's a couple of ways to get there. The shortcut, the short access, is to go to www.rhodesstate.edu/SBDC. And I'm not exactly sure why, but you do need to type the www before it. Even though Google is going to take it away, if you don't do it, it won't go down there. And then you're just going to scroll down to the tool and resources box and then learn more. And then you'll see the cash flow loan tool, which actually is located right below the business plan template, which you may have already accessed from our website. If for some reason that doesn't take you where it is, because I've kind of found that it also has a mind of its own and it's kind of hit and miss, there's always the long access. And again, you can see the steps that are involved there. It is long, but you go to rhodesstate.edu, to the menu, to community, Small Business Development Center, tools and resources, learn more, download the business tools and the cash flow loan tool. So I am going to go ahead and pull that up now, and we're going to walk through an exercise where we're going to fill in some fictitious numbers to see how our fictitious business is doing. Okay, so this is exactly what I'm talking about. It did not give us what we wanted to scroll down to the resources box. So we're going to take the long way around, and that is, again, go to menu, and then we're going to go to community, Small Business Development Center. Scroll down there, tools and resources right here. This graphic takes a long time to load, but eventually it's going to get here.
Hey, Kathy.
Yes.
Your screen is still your presentation, the green screen.
Oh, I'm sorry.
No, that's okay. It's not your fault. You can't see it.
Let's try. This one.
There it is.
Okay, good. Thank you.
Mhm.
Okay, so now we're going to learn more. There we are. Cash flow loan tool. So when we click on that, it's going to download for us, and we're going to open it. And there's our Excel spreadsheet. Okay. Can you read that screen okay? It's kind of small, but hopefully you can see it. Anybody comment?
Sorry, I was talking to you and my mic was off. Yeah, it's kind of small, but if people, so if you would like it to be bigger, you can take your screen and drag it. If you hover your mouse over in between the shared screen Excel sheet and the camera angles, like all of our little profiles, you can drag your screen over to make it bigger so that you can see it.
I'm trying to see if there's a way that I can zoom in there. Whoa, we zoomed all right.
That's funny. We're zooming in Zoom.
Right. Oh, shucks. Now I'm afraid that I'm not going to be able to insert it. All right. Well, we'll give it a whirl here. Yeah, my formulas are gone. I've skewed it, I believe.
Oh, should we just be able to go back again?
Yep.
Oh no.
I
Sorry.
cannot. That's all right. I cannot. So let me get out of that. And I'm going to pull it up again. And we're going to deal with that. Let's see. Now my tab is covering what I want. There we go. View. There. How's that? Is that a little better?
That's great.
Okay, good deal. So when we do our cash flow, I want you to start with your expenses, okay? Because again, to find that break-even point, we need to know what our expenses are. So we're going to start at the operating expenses line. And the very first line we see is the owner's draw or salary. And so that is you as the business owner. What is it that you would like to make every month from the business? We're going to build that in first. It doesn't mean that you're necessarily going to be able to obtain that, because as you will recall, we discussed that it may be months, a year, or even more than a year until you as an owner can actually take a draw. But for all intents and purposes, in our perfect business world, we're going to go ahead and build in what you would like to get per month. So let's say that is $2,000, okay? That would give you a $12,000 annual salary. So we're being modest even at that, but we're going to start with that and be at $2,000 per month. Now notice on the next line, it says it's the self-employment expense for your draw. And what that basically means is you're going to have to pay that in taxes as the income. And again, I'll remind you, you're only taxed once according to your income tax bracket on the profit you made. Let me restate that. So the profit you make is only taxed once according to your income tax bracket. We're saying that's going to be approximately 15% of your salary. And that's a pretty good number. If you can put back 15% of your salary, so at the end of the year, you're prepared to pay those taxes, you'll be in pretty good shape. So you can see that our Excel spreadsheet has automatically taken the 15% of 2,000. And so again, it's tallied it over here at $3,600. The rest of these expenses, some of them are going to be consistent and they will be the same every month, like your lease, for instance, and probably your telephone, but some of them will vary. And so we'll have the opportunity to make those changes on a month-to-month basis. So the next line is a big one. That's our wages. So if we're going to have employees, we need to figure how many employees we need per shift and how much an hour we're going to pay those employees. So for our example, let's just say we're going to have 2 employees.
Can I have all the participants say something about the audio? I'm not able to hear anything all of a sudden. And it may be on my end, I'm not positive. Could one of the participants let me know if we can hear Kathy? Or us?
I can hear you guys.
Okay, it's something on my end. Sorry to interrupt.
No, that's no problem. Thank you. I'm glad you clarified that. I'd hate to be sitting here chatting to myself and nobody hear what I'm saying. So thank you very much. Okay, so we're going to have 2 employees and each one is going to work 20 hours per week. So we really only need one person at a time to assist us, okay? So we're going to pay them. I'm doing easy math here again. I like to make my examples easy, so I'm not looking at working on the calculator at the same time. So let's say we're going to have 40 hours of wages per week times 4 weeks in a month. We're going to have 16 hours in wages, right? And we're going to pay those people $10 an hour. So that's going to give us $16,000 a month in payroll. So as soon as I put that number in, that is got to be 1,600. Sorry, $1,600 dollars per month. As soon as I put that number in and I hit enter, the next line becomes the payroll expenses. Again, that is approximately 30% of the wages. Now you'll notice a similarity here. Payroll expenses are 30%, whereas your owner's draw is 15%. The reason being is because you, as an employer, need to match the Medicare and Social Security withholdings from your employees' wages. So that becomes $480 a month. So now if we look over here in our totals and we add actual cost of our employees, we're going to see that we're at roughly $26,000 per year because we've got basically one full-time equivalent employee, okay? So when you're considering hiring an employee, obviously their wages is a big expense and it does make a big difference on your break-even point, okay? So many times people will say, I'm just going to 1099 my people, because as a 1099 subcontracted employee, you are not required to pay these matching expenses, okay? But there is a very fine line in the IRS rules and determinations between a subcontractor and an employee. And so I am happy to have that conversation with any of you. You can find a complete bulletin at irs.gov. And I will tell you this, obviously, for 30% less money, every employer would like to have them as a subcontractor. However, the IRS is looking very, very closely at that and doing a lot of audits. And if you were doing it inappropriately, whether it's intentional or unintentional, there's a very large penalty and fine that come along with doing it the wrong way. So I highly encourage you to make sure that you're aware of the difference and that you're doing it correctly, okay? So then we're going to move on to advertising. And we talked about marketing. Nicole did a great job in sharing that session with us. And so what are we going to budget every month for advertising? And unfortunately, many businesses say, well, I'll just spend whatever is left. But, you know, truly that is not being effective, because as we also discussed, many times the first thing to go is the advertising budget when the economy slows down, or for example, in 2020, when we had the pandemic. However, during those weak times is really the most important, to keep your name out there and make people aware that you are still open, you're still in business, and that you're doing things to make it comfortable for them to do business, okay? So we need to put some sort of a number in here. And so I'm going to go with a conservative $300 a month, okay? Now, I put that in there for, by the way, this, we can start with January. You can change these to whatever months. So here we are now at the end of April, you know, perhaps it's going to be June when you actually start your business. Nonetheless, it's on a 12-year schedule, so you can fill the months in accordingly. But I'm just, again, for our example, going to use January. So in January, I'm going to budget $300 a month. But let's say our busier time becomes, you know, we have a greenhouse. And so getting into April here, we're going to start really ramping up our business. And so in April, I want to be more competitive. I want people to be aware of me. So maybe I'm going to bump that up to $600 in April. And you can go accordingly. Again, if you're seasonal, it might be a little bit different. Otherwise, it might be kind of flat. And do your advertising straight across the board. So what I have plugged in so far is $1,800 for the year in advertising. But again, we're going to concentrate on January. All right. Now, I don't know if you'll have an accountant or not have an accountant. In my business, I am only going to have an accountant do my quarterly taxes. And so they're going to submit those to the state for me. And so January, February, and March becomes the first quarter, and our taxes are due the following month. So that's in April. So in April, I'm going to budget for an accountant fee. And I'm going to say it's going to be $250 to do that. Now we've started in our second quarter in April. So we have April, May, and June, which make up our second quarter. And again, our accountant is then going to work for us in July. So we'll put another $250 in there. We go into yet the third quarter of August, September, and October. And so in November, they're going to also do our quarterly taxes for us. And then lo and behold, comes December, and we're going to be looking at doing our year-end preparations, but we're not actually going to have them to the accountant until maybe January. So while this technically would go into the next year, we're going to go ahead and plug it in here because we know that come next year, we're going to need something, need that budgeted. So maybe that's $400 in January. And then you can see that the Excel spreadsheet said, okay, we're going to do this every month. And I said, no, we're not. So we're going to go through and just delete the numbers that we didn't want in there, because that's not in our plan to have an accountant every month. Okay, now we're back on track. So our accounting fee for the year is going to be approximately $1,150. Now, what about dues and publications? So it used to be a little more common when you were in a doctor's office, you would see all kinds of magazines and those kinds of things in there. Maybe you subscribe to an association of the Realtors Association that has a dues fee. Certainly your local chamber of commerce is a good investment of dues, and that would come with a minimal fee. And those might be due semi-annually. So let's say we're going to have $150 in January, and then come June, we're going to have another $150. But we're certainly not going to need $150 every month. So we're going to correct our spreadsheet to reflect the true expense that we're going to experience. Okay, so now we're at $300 a month that we're going to pay for miscellaneous dues and publications. What about utilities? If we're going to rent an office or a storefront, we obviously have utility bills. So our store is not very big, so it's probably going to be about $200 a month, which would include our gas, our electric, our water, and our sewage. Okay, so that's $200. And then an attorney, I don't need one on a retainer. I don't need to pay him every month. Heaven forbid if I need an attorney, I'll look one up, and then that will be an additional expense that I didn't budget for, which will happen in real life. We all know that happens, right? When we do our budgeting expenses in our personal lives, it does happen. Okay, postage, boy, that's just about a thing of history also. But we're going to be sending out a few letters, maybe some late notices, what have you. So we'll put in $10 a month for that. Equipment lease, I'm not going to have any equipment lease because I'm going to actually purchase my equipment, but perhaps you will, so we'll put in $100 a month. I'm going to lease my building at $1,500 a month. Supplies, now those are not supplies. Remember, these are expenses, okay? So they're not the cost of goods listed up here. These are actual supplies that we will need for day-to-day operations. So things like paper towels, cleaning supplies, disinfectant, hand sanitizer, toilet paper, those kinds of things, copy paper, ink cartridges, all of those variants of supplies. What are those going to be? And we'll put in $50 a month. Letterhead, yeah, that again is kind of extinct, but we may have it as a startup cost. So we'll put it in our first month of operation, and we'll say it's going to cost $200 for some stationery. Our telephone, we can probably get that for about $125 a month in a business line, whether that is a cell phone or you still want a landline. And then there's the insurance. So we talked about liability insurance. And again, that's going to depend on your specific type of business and what your liability limits are, right? But again, we're going to just say $125 a month for demonstration. Then there's trash and janitorial. And of course, that depends a lot if you're going to have a dumpster or what your business is. So we're just going to take a round figure of $40 a month for garbage pickup at our place of business. We're not going to figure the interest in here because we're going to do that when we figure our loan. And we're not going to take depreciation because my accountant's going to have to tell me what my equipment can be depreciated at. And miscellaneous, there's always miscellaneous expenses. It doesn't matter. It might be sponsoring the Little League team. It might be running an ad in the local sports program. And trust me, as a small business, everybody, unfortunately, is going to be looking for a donation. And it's very hard to say no sometimes. So I would encourage you to really think about what fits your mission and your type of business. make a list of who you wish to contribute to and kind of stick to it, because this miscellaneous column, which again, some of it can be added under advertising, but that will blow this advertising budget way out of the water. And this miscellaneous can just get totally out of control. Because again, we know they're all good causes, they're all good organizations, but we simply as a small business cannot afford to give to every single one of them. So because we're just starting up, we're going to be conservative and say $100 a month at the most is what I can do right now. Okay, so voila, we've made it through the expenses. I'm going to take a pause and see if anyone has any questions for me at this point, please. Don't hesitate to ask. All right, well, this is great. Okay, so we just look at the first month of operations. Was there something come up in the chat? No? Okay. And right now, as we sit, we're at a loss of $7,680 for the month of January. Okay. Going across for the year, we find that basically we have lost $77,510 for the year. Okay. But obviously, we have not put any of our income in yet. So what is this telling us as we figure our expenses is that we need $7,680 of profit, operating profit, in the month of January to pay our bills. So what does that become? That is now our break-even point, okay? So we're going to go back up and we're going to now fill in our income. And so we're going to do that math, and we're going to say at $7,680 to break even, if our selling price, if our sales price, we'll use the example we did before, we're selling a product for $10 each, how many do we have to sell in a month to hit our break-even point? So that we know we want to do $7,680 in our gross income to pay those sales tax. Okay, so let's start here at our cost of goods and look at our inventory. Again, in our example, we're just going to round this up and we're going to say that our cost of goods is $5 and we are selling it for $10. Okay, so if we sell one item and our cost is $5, our gross income is $5. So as we saw in the example before, let me grab my calculator here. We're going to take that 7,600, and now it says 75 because I've added some income, right? So we're going to take that back out. Okay, now we're going to get back to our original number, $7,680. And we're going to divide that by our profit margin of $5. So that means we have to sell 1,536 of those. So 1,536 at $10 a piece. Okay, it's going to be 15,360. And then our profit margin is 100%. So if we sell 15,360, that means our cost is going to be $76.80, leaving us a gross income of $76.80. And so down here, our expenses were $76.80. So now we have no profit and no loss. So what did we establish? We established that our break-even point is $15,360 in sales. Again, if we are selling that item for $10, that means we need to sell 1,536 of those in a month. So let's break that down weekly. And we're going to say we have 1,536 in a month. We're going to divide that by 4 because there's 4 weeks in a month. That means we have to sell 384 of those every week, okay, to cover our bills. So 384 per week, and we're going to be open 6 days a week. We have to sell 64 of those a day in order to cover our expenses at $10 per item, okay? 64 of them a day, and we're open, let's say 10 to 5, so we're open for 7 hours. That means we have to sell 9.14, or let's say 10 of those per hour. So every hour we're open, we have to sell 10 of whatever that item is at $10. Let's use the restaurant business. Let's say the average sale per customer is $10 for a lunch. Okay. So can we actually sell 10 lunches in an hour every day? Okay. For the 6 days that we're open. And that's kind of how we look at it to say, is this feasible? Can we do that? All right. So the problem is we have no cash down here to carry over into February. And obviously, we're going to have some bills come due, like our utilities. What else do we have in here? Our building lease, which we don't even have listed in. Yep, there it is in February. Okay, our building lease is going to be due probably the first of the month. So, wow, we're going to need some cash to carry over to start the month of February. And so then we know we have to sell more than that, right? And so then we do the math again. So now let's say we want to do 25,000 in sales. Oh, 250, that'd be nice. Okay, and again, because of our markup we're taking, we know that's $12,500 that it's going to be in cost. Now we have $12,500 to work with, and we come down and there's 4,820 that we can carry over to start the month of February. Boy, that feels a lot better, doesn't it? Now we can pay some bills. Whoops, didn't like that. Okay, but we're going to add that in to start our cash for February. But now we have to say, wow, is that 25,000 per month really feasible to do? So again, we're going to take $25,000 and we're going to divide that by our $10 sale. That means we have to sell 2,500 of them in a month. And again, we're going to do the simple math. There's 4 weeks in a month. So that means it's 625 per week. And then we're going to divide it by the 6 days we're open. And that means we have to do 104. 104 per day and divided by the 7 hours we're open means that's 15 of them in an hour. So every hour that we're open, can we sell 15 of those? Okay. So that's kind of how you do it. Now, obviously, we have simplified this. We've dummied it down a lot for easy math. Number one, again, $10 per item is conservative, even if we are figuring, a lunch in a restaurant, perhaps. But if you have multiple products and services, it's going to vary. There's no doubt about it. Let's take cosmetology, for instance. Are you going to be doing cuts? Are you going, there's so many different options. How many colors? How many cuts? How many perms? All those things make a difference. So you kind of have to, again, use those industry averages that we looked at and take an area similar to ours and say the average ticket or the average sale for cosmetology might be $25, or it might be $30. So we'll use the average for the purposes of our cash flow projections. Now, once we're up and running and open, we start to see the trend and we get a little bit better numbers. But again, if you're a startup business, it's just a projection. So all we're doing is taking an educated formula and coming up with a number that we can plug in to see A, if this business is feasible, B, if we do need to borrow money, are we able to make that loan payment? Which brings us to the new tab down here on the bottom. Okay, so we got our cash flow here, and now we're going here on the bottom to the loan tool. So let's say we need to borrow money from the bank. Maybe we want to borrow $25,000. The interest rate today is probably about 6.5%. And next week, we're going to discuss some of the ways that you can borrow money and the parameters that might be involved. And so because we're going to use it, we're not using it to purchase a land or a building, right? We're going to be using it for equipment, furniture, operating expenses, inventory. We're probably going to get only a maximum of 7 years on that loan. If it were a building and land, obviously it would go to 25, between 20 and 30. But because it's not, we're only going to give it 7. And yes, we're going to make 12 payments. We're going to make one a month. So the total payments on that loan is going to be 84. And so we can come down here and see that our monthly payment for our loan is going to be $371.24. The interest is $135.42 of that, while the principal is just $235. Okay. But nonetheless, this is broken down just like a banker would do for you. It's called the amortization schedule. And we know that this is, again, going to be $372 roughly dollars a month. Now, if we come back over to our cash flow, it plugged that number in down here at the bottom, the loan from the bank, okay? And so it's $371 a month. It's going to take that out. We're not going to have any taxes because that's a reserve for payroll taxes. And because we're leasing our building, not owning it, we don't need to worry about that one. So it's going to take $371 out. And now we have $4,449 to carry over into February. But the good thing is, if we're able to reach that sales revenue, we're sitting in a pretty good position right here, okay, to have that kind of a carryover into the next month to start making our payments and paying our bills. Let's say that we decide I cannot sell that 15 of those an hour. Let's go with 18,000 in sales for the month. And we're going to go with, again, the 100% markup. So we're at 9,000 is our cost. Now we've got our loan payment in there. Now we're at $949 carryover. While it's good to have carryover, that really isn't going to do much for paying any of our bills, is it? Okay, so again, if our lease is $1,500, we're not likely to even have enough money to make the lease payment when it comes due the 1st of February. So there's basically 2 ways that you can change your projections. Anybody have an idea of what 2 options we have to make this cash flow projection sheet look different? Well, we can either increase our sales or lower our costs, right? Okay, we already established that if we were at 25,000 and make the $4,000 profit, our cash position at the end, that was too steep for us. So it's probably not likely that we're going to be able to increase our sales revenue. But look at this, we've got an other column. So while we're talking about selling plate lunches, maybe there's something else. Oh, everybody likes a souvenir, right? So we're going to have some t-shirts printed. And we're going to help those people not only advertise for us, but we're going to make some money on those. So let's just say we want to get those on people's backs. So we're going to take a little tiny profit on those. So let's say we're going to take $3 on a shirt. Okay. Now we can also add a line here that's going to say not our cost of goods for our major sales revenue, but for our t-shirts. And they're going to cost us $7 a piece. Okay. And when I just set up here, I'm going to sell 100 of them. So we're going to have $700 in costs there. Now what happens? Oh, that's a little better. We got 1,249. Okay. So you can see how I massaged that a little bit. And as I said, souvenirs, maybe it's t-shirts and mugs or whatever it wants to be. Okay. But then we're going to refigure what that income is. So that looks a little bit better, but we're still short of making our lease payment. So we know we need to have a little bit more in this cash position. So it's not realistic to increase our sales anymore. So our only other option is to reduce our expenses, right? And as we go through the list of our expenses, let's take a look at them. Our advertising, we've been pretty conservative on all of this. Our accountant, our dues, we certainly can't change our building lease. We can't change our telephone or our insurance. Those are all fixed expenses. So we basically have two expenses that we can look at changing. One is the wages, right? Well, again, we've only got one other person with us there for 40 hours a week. So can we really afford to drop there? Might be a little tough to do. So let's look at our own salary. Remembering that we may not get what we want to get in the very startup months of our business. So, well, I'm going to have to go down to $1,000 a month at startup, and that's going to make my my employment expense half of what it was, $150, and now we have $2,399 to carry over into February. Well, that will get us going. That will keep us ready to order inventory and ready to pay our bills until we sell some more merchandise in the month of February. Okay. So what we have done here this morning, what I've demonstrated to you, I'm going to put in here that this is year one. Okay. Whoops. Year one. And our company is going to be called XYZ Food. Okay. If we're going to go to the bank to get this loan that we talked about, that we based everything on for $25,000, the bank is going to want us to have 3 years of cash flow projections. And quite honestly, most private investors will want to see that as well. So now we've got the groundwork laid. We can go back to our year one sheet that we've done, and we can replicate that for years 2 and years 3. All right. So we're going to change that to year 2. And now we're no longer new in business. People know us. So maybe in year 2, in our written plan, we have indicated in our goals and projections that we're going to increase by 50%. Okay. So if we're at 18,000, we're going to go another half of that. Now we're going to go to 27,000. Okay. And again, we're going to use this number and say we're at 13.5 then for our costs. We're not going to worry about the t-shirts now. That's a minimal expense. Okay. Wow. Look what happens here. Now we have $6,899 in our first month of our second year. So by golly, I'm going to bump back up, and now I'm going to get my 2,000 that I planned. Yep, I can do that. We still got a nice carryover here. Okay. But we know the cost of doing business goes up every year. So it's easy to project then our income once we've got that the break-even point figured in our first year sales basis. But in the second year, how do I know what my operating expenses are going to be? Suggestion to you is to increase every one of these columns by 4 to 5%. Okay. So you're going to take your 1,600 in wages. You're going to give your employees a raise the second year. And maybe that's a 4% raise. I'm arrived at that 4 to 5% because we're looking at the cost of living increase from year to year. 4%, 5% is a little bit higher than what we've seen. But again, we're budgeting. And I recommend that you budget on rather than have surprises and being cut short. Okay. So typically the cost of living has been 3.5 to 4%. So let's add 4 to 5%. So let's go back again to our wages, and we're going to take $1,600 that we were at, and we're going to increase that by 4.5%. That now becomes 1,672. That doesn't sound right. Let me try that again. 1,600. Yep, that's right. Okay. So now our payroll expenses, as you can see, jumped up, right? Advertising, and so we're going to increase that by 4%. So 300 times 0.04 is $12. So now we're going to make that advertising $312, and so on and so forth. And you can see as we go through, you can change all of those. Lease, maybe we don't have to increase that because we're locked into a 2 or 3 year contract. Okay, same way with our equipment lease. That's not going to change. Utilities will change, so we'll bump that up again. And as you go through and do that with each column, and again, each month, particularly if you're a seasonal business, and every business is going to fluctuate, okay? In Ohio, it's a given. January, February, March are kind of going to be probably some laws, right? We're going to be looking at slow times because of our lovely weather and what have you. And so keep that in mind as we're looking at our sales projections. And then we'll be able to then basically say, okay, now we're at year 2 for XYZ food, and we're still doing okay. We've got bigger, better carryover. And then on a third and separate sheet, you will also be able to do your year 3. Just keep in mind that everything you put in your written plan has to tie back to these numbers and vice versa. Okay. So a lender is going to look at them and say, do these match? And even if you don't go for a loan of any sort and you're looking at it for, you know, your employees for your own personal record keeping, you need to know that these are realistic. They're not pie in the sky somewhere, that they do tie back and make sense. And that's when we go back to the SMART goals. Okay. Are they specific, measurable, attainable, realistic, and timely? So the time comes in of January of year 2. Okay, that could be timely. Is it attainable? Are we going to double our business the first year? It's not likely. Okay. But again, in our example, so in January, we have done, let me get back up to the income. We have done $27,000. Well, we're actually in year 2. Let's go back to year 1. Okay, and we're only going to do 18,000 in January. Okay, but this, as our name gets out and people start liking us and they're learning about us, you know, that could continue to gradually rise also in some realistic number. And so later on, as you go through year 1, it may not look the same as our first month did. But again, we have a starting point and we need to start somewhere to find that break-even point and build from there. Okay. I'll ask again if there are any questions.
I love this cash flow tool. I think it's great to even use for personal finances.
You're absolutely right. And I'm glad you brought that up, Nicole, because some of my businesses, particularly smaller businesses, remember, we discussed what makes a good accounting system. And I said, you don't need a big fancy computer program necessarily. Some of my clients even use this as their actual bookkeeping. Okay. So instead of being a monthly cash flow projection, they are now using it as their monthly cash flow. Okay.
That's awesome.
So they'll record actual sales here and their actual expenses. And especially doing it in the first few months, it really then helps you to take a look and say, what's the rest of the year going to look like? And you can totally do that. You can do it month by month, or you can do it week by week and still use these formulas that we built in for you. All right. And I'll say this, this happens. Some people will mess up a formula, whatever, it's not working. Oh no. Remember, it's always on our website. You can go back and download it again and start fresh and start new. And that works. Or if you run into a problem, you know where to find Nicole and I. We're not far away. All right. So, wow, that brings us to 11 o'clock already. That hour has flown by for me.
It has. That is crazy, but that is great information. And Kathy, thank you for making cash flow feel not so intimidating, first and foremost, and two, not so boring, because sometimes we know that stuff can be boring. Even though money is exciting, we still have to be able to manage it. And that's a great tool. So thank you for sharing that with us.
Absolutely. Thank you.
So as we had stated before, this is recorded, so you can go back and reevaluate when you're working on your business plans. And please don't forget to send them in to Kathy. You do have her email address at keller.k@rhodesstate.edu, or you can reach out to me, Nicole, and Scott@lymanchamber.com, and I can get those questions to her as well. With that being said, next week is our last week, and we have a guest speaker. We're going to be talking about insurance. And with that being said, everybody have a wonderful week. Stay warm, and this weekend we'll be back. So thank you. Bye-bye.
Amen. Thank you. Have a good one, everyone. Bye-bye.
Bye-bye.